Good afternoon, everybody. My name is Robert Joseph Taylor. I'm the director of the Program for Research on Black Americans. And this term, the Program for Research on Black Americans and the Michigan Center for Urban African American Aging Research are pleased to host the Group Dynamics Seminar. This is one of the longest running seminars in the social sciences. The Program for Research on Black Americans was founded by James S. Jackson in 1976. And we're one of the few groups like us that are still around. All of our competitors have been gone for at least 2 decades now. Our research programs conducted several major national surveys of African Americans. It has also had a major training mission, training hundreds of students and postdocs over its history. For instance, 9 former students became full professors here at the University of Michigan, and 3 of them are collegiate professors. Today's speaker, Dr. Terri Friedline, is an associate professor of social work and is just beginning her 2nd year here, or I should say in the middle of her 2nd year here. Before that, she was an assistant professor of Kansas, and I'm pleased to say I was chair of the search committee that hired her here, and we're very pleased. Dr. Friedline's research is on financial inclusion. In particular, her work examines discrimination in banking and credit and how this inequality leads to dramatic differences in the accumulation of wealth. Her research has been published in top journals, and her work has been covered by numerous national media, including Time Magazine, the Huffington Post, CBS News, and Bloomberg Business Week. So let's welcome Dr. Terri Friedline.
Thank you. Well, thank you, Dr. Taylor, for the introduction. I'm really pleased and honored to be with you here today and to present this work as part of this speaker series. And so I'll be talking today on the racialized costs of traditional banking in segregated America. And before going forward, I should mention and acknowledge really important collaborators who have helped to make the paper that I'm going to talk about today possible. And the first is with my co-author, Jacob William Faber, who is at NYU's Wagner School of Public Services. And we work together to produce the paper and the results that I'll be speaking on, as well as numerous graduate research assistants who helped to collect the data, whose work was really critical in the development of the study, the data collection, that we, I feel like I'm stumbling there, that helped to collect the data for the study. That's what they did, and it was really helpful. What I'm going to be talking about today is how financial services, policies, and practices contribute to exclusion from economic markets, from the financial system in particular, in ways that are specifically anti-Black. So part of the work is going to talk about communities of color, but the results that I'm going to present and talk on are really about anti-Blackness. And this is not new work. This is work that I'm presenting on, with contemporary relevance to communicate that discriminatory practices in financial services are ongoing and they're present today. The data that I'll be talking on was collected in 2016 and 2017, and so these are very, pretty new data. This isn't, something that was, just occurring, in decades past. And so James Baldwin has this quote in 1961 talking about particularly segregation, how segregation can create what he refers to here as captive populations. Creating these geographically based segregated areas where exploitation is easier, where victimization can happen by the ways that financial services like auto insurance, for example, can target people who live in those segregated areas. In 1980, he gave a talk. This talk on Black English happened at Wayne State University, so not so far away. And I think his quote is particularly poignant here. "White is a metaphor for power, and that is simply a way of describing Chase Manhattan Bank." And so So, clearly Baldwin is writing and thinking about white supremacy in the financial system and those being synonymous and helping to produce anti-blackness. More recently, Mercer Baradaran, who's a professor of law at the University of Georgia, she's written a few books. The quote where this one comes from is from How the Other Half Banks, and talking about how it's increasingly expensive to be poor. So, all of the costs and fees. There's a good bit of news, lately about the costs and fees related to jail and bonds and the justice system, the criminal justice system, and the same is true for financial services. And so, the idea of discrimination in the financial system, has been ongoing. And there are a couple trends, two trends recently that make this, of continued importance. And the first is the rising cost of traditional banking. So if you can see on these two graphs here, so the ATM fees here on your left, the green chart, you can see how those fees have been rising over time. So, today, the average out-of-network ATM fee, is just above $4.50. It's a pretty substantial increase from, just 1998. And then the median overdraft fee, which is actually now it's around $34. $34 for a transaction that, when triggered, is only about $4. So the transaction that triggers an overdraft is about the cost of a cup of coffee at Starbucks. It's $4. The overdraft fee the banks charge is $34, median of $34, which is, at thinking about interest rates, pretty on par with interest rates charged by payday lenders. And so this is, some of the ways that the costs of banking are rising, and begs the question about whether banks are too expensive to use. And the second is the expanding alternative financial services industry. So this alternative financial services industry, payday lenders, check cashers, rent-to-own shops, title lenders, they have been rapidly growing, opening new locations, physical locations in communities, pretty substantially for the last few decades. So you can see, this kind of the red bars going upward. Represent the number by county across the United States. And the second, with the blue bars, are from New York City. And we can see in the 2000s really a pretty substantial increase that even continued after the Great Recession. So when the Great Recession hit, as banks started closing, check cashers really blossomed in communities that had been hardest hit by the foreclosure crisis. So these types of alternative services are growing. They're simultaneously growing while bank branches are decreasing their physical footprint. So bank branches are, trending downward. They're closing branches in favor of online and over-the-phone types of services. Whereas on the other hand, this higher cost industry has been really growing. And so these changes matter for a few different reasons. And the first is our growing reliance on technology. And technology means that we need institutions to manage our money for us. And so this means that tools for wealth accumulation, tools for participating in the economy become really impossible without a bank account. So just as an example, if you think about mortgage lending, it's really hard to apply for a mortgage if you don't have a checking account. It's almost really hard to apply for a job if you don't have a checking account. And if you're not, if you don't have some sort of record in the financial system, then it becomes difficult to offer a credit score, which employers, which lenders are increasingly using to make decisions about kind of quote-unquote risk and who is worthy of kind of responsible financial services. The other is acculturation. So this suggests that kind of the growing presence of alternative financial services and the shifting dynamics of banks and payday lenders and credit unions in communities has an effect on financial behavior. So if there's a payday lender that's closer, it's more convenient, and by their presence, that suggests that this is a financial service that I can use to meet my financial goals, then I may be more likely to use them. There's also the predatory nature of alternative financial services, and this, basically suggests that alternative financial services, payday lenders, they can really cost a substantial amount of money over one's lifetime. So over a career, one can spend about $40,000 using a check cashing outlet, which is a lot of money to send to a check cashing outlet that could go, into your everyday expenses. And the next is structure, and I'm going to talk a little bit more about structure in the next slides. But alongside increasing income inequality, instability, segregation, if we remember James Baldwin's quote about creating captive populations, this concentrates economic vulnerability in ways that financial services can take advantage of. And given that income inequality, given that residential segregation are both racialized, then the concerns about trends in financial services are then too. So the housing boom and bust, the Great Recession. So as the economy, was diving and banks began to contract their lending, foreclosures were rising, alternative financial services were growing. And segregation is positively correlated with having subprime lending, with racial inequalities related to a recovered housing market. So the types of loans that were being offered, whose homes were foreclosed upon, how new loans were being originated. Black communities in particular, were less likely to experience the benefits of a recovered market. And so this stark racial geography in the background, you can see the redlining maps. When we traditionally think of discrimination in financial services, we often think of redlining that helped to create these economically captive racialized communities. That this racial geography shapes the costs of how we use money and provides a way for banks and for payday lenders alike to extract wealth from the communities, from the households that live there. So most of the attention, I think, on this dynamic focuses on alternative financial services. And so alternative financial services, these include, the gamut. I'm lumping them, all into this one broad term, despite each of them offering slightly different products or services. But these include the payday lenders, the check cashers, pawn shops, rent-to-own stores, subprime auto lenders, and segregation both at the neighborhood level and the metropolitan level across cities shapes where these alternative financial services locate and how they provide financial services to communities. And so these two graphs both show kind of how those enormous disparities exist. So you can see across census tracts by census tract racial makeup, with the first bar on this left-hand side, left-hand graph representing white, black, Latinx, and then other non-white groups in census tracts, that for majority black and Latinx census tracts, the presence of alternative financial services, check cashing outlets in particular, is a good bit higher, particularly compared to white census tracts. And in the graph right next to it, these varying shades of gray represent the composition of financial services within white, black, Latinx, and other census tracts. So one of the bars you want to look at is this light shaded gray here, indicating the number of banks in a particular community. So in a white census tract, we can see kind of the distribution of banks within a white census tract, the distribution of banks within a black census tract, within a Latinx census tract, and other non-white census tracts. Comparatively, or conversely, you can see this middle bar here representing more alternative financial services in those particular census tracts. So across census tract racial makeup, we see different compositions in the financial services kind of ecosystem that communities and that their residents experience. And so to give you an idea of what this looks like, how these disparities exist, and how they kind of present at the metropolitan level. This is a map of Chicago, and you can see kind of the gray, increasingly darker shades of gray census tracts in the background. These census tracts, these darker shades of gray, represent increasing concentrations of black populations within census tracts. And the red dots represent the number of the alternative financial services. So each dot represents a different alternative financial service in that Chicago metropolitan area. And pretty clearly here, the red dots, really pattern around black communities. This is an example from Detroit, and you can see while there appears to be a fairly decent spread within Detroit and around the kind of the metro region. And what I mean by that is that there are alternative financial services in white census tracts, or alternative financial services in black census tracts, and it appears that there's a more even distribution across census tract racial makeup. When we look at the locations of banks, so these are locations of bank branches across the metro region, and they have almost a kind of like an opposite trend to what we saw in Chicago. And so there are banks kind of distributed throughout the metro region, but they are concentrating more so in white census tracts around the city of Detroit than they are within black and brown communities in Detroit. And so I'm going to be talking today about the racialized costs of kind of traditional banking in banks, because banks often escape scrutiny in their practices. When we talk about racial disparities, as I mentioned, we tend to often focus on mortgage lending and less so the other products and services that banks offer, but they can do so throughout the array of products and services that they offer that are also offering them in ways that are also predatory. And so banking sometimes is presented as a solution to the growing alternative financial services industry, whereas it may more likely be two sides of the same coin, part of that same coin. I've mentioned the history of exclusion, their contemporary practices of avoiding communities of color, and rising costs and fees. So we saw how ATM fees are rising over time, and overdraft fees as well are rising over time. And these are practices that, just like alternative financial services, just like payday lenders, are also predatory. And so there are a series of books. This first one by Kaplovitz, The Poor Pay More, that was first written in, I think, 1964, documenting how banks in some of these other ways extract money from communities of color at higher rates. All the way up to present day, Mercer Broderon's most recent book, The Color of Money, talking about how black-owned banks really have been undermined by the rest of the financial system that as much as black-owned banks in many communities are working to serve the community, still are kind of under the pressures of the financial system that result in wealth extraction as well. And so I'm going to present the results today on our recent data, which are on the racialized costs of traditional banking. And so this research has really the goal of analyzing geographic variation in the cost of banking. I'm going to focus on entry-level checking accounts. I'm going to focus on these checking accounts because they're one of the first products that a person owns or opens when they become connected to the financial system or to a bank or a credit union, which means that they're ubiquitous. So about 92% of the population owns a checking account. So this is, an opportunity for kind of widespread access and use, and also predatory practices. And they're also prerequisites for many of the other financial tools that we need, like auto insurance or homeowners insurance or home mortgage lending. So while they seem like this kind of small, potentially small financial product, they're a gateway to much of the other products in the financial system and to the economy. So the data that I'm going to present on are from a survey of main bank branches across the United States. And so this is a map showing all of the locations that participated in the survey, all of the bank branches that participated in the survey. And they're spread, pretty much across from coast to coast and north to south. And we surveyed a stratified random sample of banks, 1,625 banks from across the country. We worked with the FDIC to follow some of their surveying processes. So they have annual surveys every few years where they randomly sample from banks and collect this type of information. And so we worked with them to kind of model that sampling procedure and stratified along assets and non-metropolitan areas. Assets meaning kind of the size of the bank and how much kind of wealth and capital that the bank holds. The sample that I'll be presenting on comes from 1,344 of those branches. And it's important to know that these are main bank branches. So the FDIC has this special designation in their data that says, whether or not a branch is considered a main branch. So JP Morgan Chase might have 20,000 branches around the country, but one of those is identified as a main bank branch. And so we sampled those main bank branches. We also kind of analyzed to see whether or not, branches located in other areas maybe differed significantly from the communities where main banks are located, and we didn't see any evidence, for example, that main banks were located more in white metropolitan financial districts versus black or brown communities in neighborhoods, that there was a really high correlation between main bank branches, where they were located, and the branches across the rest of the bank. We matched the responses to census tract data so that we could merge in racial makeup, and we did so using the percent Black, the percent Latinx, and the percent Asian, and did so at the census tract and the census place level. So the census place level includes things like cities and towns, and we controlled for the foreign-born population, educational attainment, poverty, many of the other covariates that we think could help explain some differences in checking account costs and fees. We also measured the competitive environment. So we measured the number of bank branches, the density of bank branches based on the census tract population, the density of alternative financial service providers, so that we could, control for that local market of perhaps banks might be, cost more given the presence of payday lenders or check cashers, or given that they might be the only bank providing services in the area. That may change how they price their products, and that was something that we controlled for as well as bank size, the assets that they held, and the person that we talked to at the bank. The way that we delivered the survey was by calling the main branch and asking the person who answered the phone to answer our 57 questions. When I acknowledged my co-author and graduate student assistants, I probably forgot to mention all the tellers and branch managers and customer service representatives who spent valuable time out of their day responding to these very detailed questions about their financial products. Interestingly enough, I think, it reminded me much like going to Best Buy and asking the person to give me detailed information about the electronics that are available on the store. Many tellers and branch managers didn't necessarily know all of the details about their products and services. And so the answers that we receive from the survey represent what a person might actually get, right? When you walk into the bank and you ask about a product and service, the level of that person's knowledge is reflected in the survey, whether or not that's actually accurate per bank policy. And this is important because when the FDIC kind of delivers their survey results, they're asking and reporting on the very specific bank policies. So what the standard operating procedure manual says. But this is the difference between policy and practice, and we're looking to see, what happens on the ground when someone's going into a bank and asking about a checking account. What type of information do they get? So limitations, some of those that were embedded just in that description that I shared with you, but some of the limitations include that these data are cross-sectional, so we're not accounting for changes over time, and we're looking at correlational relationships, although we don't think that this necessarily undermines the results. Data are most representative of community and small banks. So the example that I gave you about JP Morgan Chase having about 20,000 branches around the country, there are fewer JP Morgan Chases in this survey, which means that we aren't necessarily using one main branch to represent 20,000 branches, right? So we are mostly looking at small and community banks with just three or four branches within their banks. And so main branch sampling also doesn't account for regional geographic variation. What JP Morgan offers in California is different than what they might offer in New York. And we actually think that the data underestimate, given some of these limitations, we think that the data underestimate really the extent of racial disparities. Because most of our bank branches are located in white census tracts, and we didn't oversample banks and communities of color. We didn't account for that disproportionality. So I'm going to present to you a series of linear regressions. I'm actually going to present the summary from those series of linear regressions that look at the costs and fees of checking accounts. So these are things like the minimum opening deposit. They're the overdraft fee amounts, whether or not there is a regular maintenance fee. So, you may be charged anywhere $5 to $15 per month or $0 per month to just maintain your checking account. These were the costs and fees that we looked at in our analyses. So we started just by introducing the community racial demographics. We added demographic controls, and then finally concluded with banking characteristics to see if we could explain away the relationships between census tract and census place racial makeup and the costs and fees of checking accounts. So these are descriptive results. And we're starting here with minimum opening deposit. And so you can see the minimum opening deposit is just about $69 for banks located in white census tracts. And on average, it is $81 and $97 in black and other non-white census tracts. So, about $10 to $13 difference between white and black census banks located in white and black census tracts, which is, that difference, money that residents of those communities don't get to keep for other expenses in their lives. Minimum balance. The minimum balance is something that tends to be higher. The average minimum balance across all banks in the country is around $1,500. So this is just the balance that you have to keep to not be charged, not be charged any fees. And so in our data, the average minimum balances for census tracts where banks are located in black census tracts and other non-white census tracts is pretty significantly higher, descriptively speaking, than in white census tracts. In white census tracts, $625 compared to $871 in black census tracts. Pretty substantial difference. And maintenance and overdraft fees. I'm going to talk just about overdraft fees because they'll come back to us in a little bit. In our data, the average overdraft fee in black census tracts is $32. That's $2 more than what's charged by banks in white census tracts. And so these are the results from our regression analyses. And I'm just presenting you the summary here on the percent Black, Latinx, and Asian populations. And you can see across our outcomes. So the minimum opening deposit, the continuous outcome looking at the amount of that opening deposit, minimum balance, the service fee, and the overdraft fee. And you can see for the percent for banks located in census tracts, or for census tracts with increasing percentages of percent Black population, the minimum opening deposit, the service fee, and the overdraft fee are all significantly higher across census tract or census place estimates. And this is fairly consistent with the percent Latinx in census tracts, with the exception of overdraft fee. There's a negative relationship with overdraft fee here, though everything else seems to be trending positively and significantly. And only on the minimum opening deposit is that significant for the percent Asian population. So these are in our fully controlled models after adding in community demographic characteristics and also bank characteristics. And so we see the density of alternative financial services, one of the other things that we controlled for. The density of alternative financial services also is significantly correlated with the costs of checking accounts. And so this suggests, one, that banks may locate in areas where costs of operating, for example, are higher, which also happen to be the places where payday lenders are located, and this raises costs per part of the spatial void hypothesis. And secondly, an alternative explanation, and the explanation that we put forth in the paper is that both alternative and traditional financial services target these quote unquote economically captive kind of populations to target for exploitation. We don't see competition from nearby banks being significantly correlated with the outcomes, so it's not that other banks in the area are driving up costs. We rarely see that as significant. And socioeconomic and demographic characteristics like education level or poverty rate also aren't consistently significantly related with the outcomes. So I also mentioned that we would come back to the idea of overdraft fee, and in our third kind of fully controlled regression model, one of the things that we added was an interaction term with the person that you talk with at the bank. And we find that who you talk with at the bank matters for what these costs and fees are. So these are visuals of the margins for the regression results that show that who you talk with at the bank matters for what those costs and fees are. Particularly tellers report higher overdraft fees in communities of color. So the blue line going straight across on both of these graphs, the blue line going straight across, those are the customer service representatives, fairly straight across. And customer service representatives are most likely the people who are sitting in front of the computer talking with you on the phone, and they have the bank policy right in front of them. So when you ask them a question, what's the average cost of what's the cost of your overdraft fee on your most entry-level checking account? They type in the question, the answer pops up on the screen, and so fairly consistently across census tract racial makeup, they respond with costs and fees. So what you see on the axes are the percent white population and the overdraft fee amount. And so regardless of the percent white population, the customer service representative's answer is consistent. The green line that's kind of sloping downward, those represent tellers. We don't see any in the orange line kind of significant relationship with other roles at the bank, supervisors or branch managers. But with tellers, as the percent white population increases, the overdraft fee amount goes down. So we see that significant correlation with the declining overdraft fee of about $2. And so this is an example of what some Tom Shapiro and colleagues at the Institute of Assets and Social Policy have called the asset value of whiteness, about how economically beneficial it can be for whiteness represented in the financial system, which results in a lower overdraft fee. We also see this with the monthly maintenance fee amount, both tellers and other personnel at the bank. Other personnel include branch managers and any sales associates. They also report lower monthly maintenance fee amounts in census tracts that have higher percent white populations. Question, yeah?
Just a quick one. Does it change anything that they give this information differently? In other words, do they assign these fees, or are they just giving information to people who ask for it?
Good question. So they're just giving information for people that asked for it. So the research assistants that I worked with and myself, we were on the phone and just said, we have some questions. What does this fee look like at your bank? And that's how they responded. Yeah, Kathleen, right? Kate.
So these were your respondents to the survey, is that
That's right.
So what
Yep.
was the relative breakdown of respondents? What percent were customer service, et cetera?
Good question. About half were tellers. I can't remember the, do I remember that right? I don't know if I can remember that right. But I think about half were tellers, and then kind of divided amongst the others.
As long as I'm asking a question.
Sure.
You might have said this, so I'm sorry if I missed it. Did you mention what the response rate was in your survey?
Maybe I didn't mention it, but we had a high response rate. 84%, I think, was a pretty high response rate. We've talked with the FDIC a number of times. The FDIC has a response rate of about 19%. And so they're very curious as to how you get such a response rate. And I think the answer is that one of the answers is that you work with amazingly persistent research team. And also, perhaps the weightiness of the survey feels a little different coming from a research team than the FDIC, right? Other questions? Can I maybe pause there? And if there are any clarifying questions, I can take those before going on. So one of the things that we did next was look at a ghetto tax required by communities of color where earnings are more so sequestered in these checking accounts. And we did so by calculating magnitude estimates. So if the typical white American lives in a census tract that is 7% Black, 4% Asian, and 10% Latinx, we can plug those percentages into the regression equation to produce estimates of what the average cost would be for the average white American based on this exposure to other racial groups. And we did the same for Blacks, for Asians, and Latinx. And you can kind of see the percentages there, and we plug each of those into the regression equations for magnitude estimates. And so you can see differences in the minimum opening deposit. So the average white individual, based on the racial makeup and exposure to other racial groups, pays about $71 for the minimum opening deposit, which is for the average black individual $85, average Asian individual $99, average Latinx individual $101. Minimum opening deposit really can range from about $0 to $300. The range wasn't quite as wide in our survey. Much closer to $60 to a $90 range on average. And so you can see some of those differences emerging based on these magnitude estimates. And so if we add up all the costs and fees, right, we had minimum opening deposit, minimum balance, service fee, and overdraft fee. If we assume that each person is going to experience at least one of those in a given time span, just one of those per year, for example, we can add up the costs of minimum opening deposit, minimum balance amount, what the total sum would be based on those magnitude estimates. And the total sum for the average white individual is $754 in checking account costs and fees. And for the average black individual, it's $190 higher, $26 higher for the average Asian individual, and $262 higher for the average Latinx individual, adding up all those costs and fees based on census tract or neighborhood exposure to other racial groups. These differences are also starker when we consider them alongside income inequalities. So the average white American needs to deposit about 3% of a paycheck into a checking account in order to, and then keep $28 in that paycheck, of that paycheck deposited, in order to avoid maintenance fees. So the minimum opening deposit, represents about 3% of that paycheck, and then to avoid your recurring maintenance fees, about 28% of that paycheck into their checking account. And those numbers, given that black and brown populations are disproportionately overrepresented in lower income communities, that the cost needed to maintain that checking account is higher, based on those income inequalities. So for blacks, they would need a 6% opening deposit to open the account, 6% of their paycheck, and 60% kept in that account to be able to avoid those recurring themes. It's fairly consistent for Latinx populations, and lower, the same or lower for Asian individuals. And so kind of the mainline findings, the summary of the findings are that banks in black and Latinx communities are more expensive. It matters who you talk to at the bank, and greater banking costs exacerbate income inequalities that are already in existence. And so this suggests that banks are also in this business, in this very kind of ubiquitous and seemingly inconsequential financial product, also engaging in predatory practices. And so I'll talk through a few implications from the research, some policy implications, and then can take your questions. So these rising fees of minimum opening balances, maintenance costs, overdraft fees, these rising fees make traditional banking more expensive. Oftentimes people can deliberately choose alternative financial services because they're perceived to be less expensive or more transparent or more honest, and banks are not necessarily this solution to this payday lending predatory industry. And in fact, part of what Jacob and I are interested in putting forward with this paper is that right now we have a dichotomy in how we talk about financial services. Alternative on one hand and mainstream or traditional on the other, without much space for thinking about them along a continuum. And really that continuum may be the better way to perceive financial services is part of this continuum. The FDIC and the Federal Reserve have had kind of long-standing working groups on the idea of kind of banked or unbanked and alternative versus mainstream or traditional financial services, kind of rarely thinking about the nuances and continuities of opposite ends, or what they often perceive of as a dichotomy. And so we want kind of all of us to think more along these lines of financial services on this continuum. This kind of spatial organization, differences across census tracts, across census places in financial services, creates differences in the value of money. So how far a dollar will go. There's heterogeneity introduced by this geographic kind of spatial organization in how banks and payday lenders offer their products and services. So costs of financial services, especially, here we're talking about banks, these depress wages of, that are already low, overrepresented low in communities of color. And it continues to create identifiable markets that banks can also target for their predatory products and services. Mercer Broderon has a quote in her most recent book, The Color of Money, about this being a quiet form of racial violence. Banks targeting communities of color, under the guise of providing, necessary financial services that individuals and communities need to make a bridge into the economy. It's hard to participate in a dignified way in the economy, without some of these basic financial products and services. And Mercer Broderon talks about this being a quiet form of racial violence. And there are good accounts of the histories of financial services where this violence is not so quiet. And so in Chicago, the map of Chicago that I showed you earlier overlaid the locations of alternative financial services, payday lenders and check cashers. But there's a very good historic description of a banker and financier named Jesse Binga, whose home was bombed 6 or 7 times as he made loans, mortgage loans, small business loans, to members of his community. He was a black financier, relocated to a white community, owned a bank, and was making affordable lending. And as part of the violence that he experienced, it was loud and terrorizing and physically violent. And this, I think, is a continuation of that form of violence. Not quite in the same form, but perhaps creating some of the similar effects. So I'm going to talk a bit about policies because what I'd like to see happen next is for policies to be able to make real and lasting changes to the financial system. And really these policies around strong consumer protections and financial system regulations. And so one is to require banks to offer safe and affordable checking accounts. So Canada, just a little bit farther to the north, almost 2 decades ago, created a policy requiring their banks to offer checking accounts that cost no more than $4 per month. So every bank in Canada offers a checking account regardless of your employment status, of your ability to pay, of your criminal history. Banks are required to offer a checking account that doesn't cost any more than $4 per month. There are some proposals that currently encourage banks to offer more affordable checking accounts. Bank On and Cities for Financial Empowerment, city treasurers, their offices are encouraging banks to lower the costs and fees of their checking accounts. This is a little bit different. The encouragement is important, and I think a strong system of regulations is needed to not just encourage but to mandate banks to offer these affordable products and services in such a way that it would not vary when you walk into one bank as opposed to another, and based on the social identities that you bring to those spaces, that your overdraft fee or your minimum opening balance would vary. Secondly is to support the Dodd-Frank Consumer Financial Protection Bureau. This was a bureau created kind of in the aftermath or during the Great Recession to have stronger oversight of financial system policies and practices. And there have been a series of kind of clawbacks from the current administration and current CFPB directors that really undermine the strength of this really important federal body that's intended to look for and ameliorate discrimination in the financial system. So supporting the CFPB is another important policy implication. And the final policy implication is to fully enforce the CRA, the Community Reinvestment Act. So the Community Reinvestment Act was implemented in the 70s to address redlining. So in order to address how banks were racially discriminating in their lending practices with regard to home mortgages specifically. The CRA really kind of conflates race and income and focuses on economically disadvantaged communities, but doesn't really have any specific provision to look at racial discrimination in the CRA. It focuses mostly on economic disadvantage and focuses mostly on lending. So if your bank is lending kindly to the payday lender that's operating in a black community, that is a process through the CRA through which that bank can receive credit. It does not have to be providing an affordable checking account or even an affordable mortgage in a community of color. It can also lend to businesses, it can lend to corporations, and can receive credit under the Community Reinvestment Act. About 97% of banks are doing outstanding or satisfactory by the standards of the Community Reinvestment Act. So they are 97% of those institutions, by these standards as they exist, are doing just fine. And we know that that's really not the case when it comes to thinking about racial disparities and anti-blackness in the financial system. And so that wraps up my presentation, and I'd be glad to talk with you about any of the findings here and your thoughts on the system and its policies. Yes.
So I have a question. So going back to the findings for who you talk to in terms of the fees and the cost opening. So is it safe to assume that for each of the banks was both a customer service agent and a teller both sampled, or was it just one or the other for most of these banks?
Good question. It was one or the other. It was whoever answered the phone.
Okay.
Although sometimes, as I mentioned, not everyone had all the information at hand. We were transferred right in the process of the survey, so the teller would transfer us to customer service sometimes. And so the results that are represented here identify the person that we spoke to last, right? But we could have multiple information.
So would you recommend that we interpret these findings as the tellers potentially giving the wrong information for the bank? Or is it safe to assume they're giving the correct information, maybe just determining if they feel the rate should be at this point in time? Like, how should we interpret this?
So I think we should interpret it as, well, we don't have information on the correct, what may be the official policy, right? One of the things that we tried to do was to map responses to information provided on banks' websites. If you're a small community bank that has 2 branches, you might not have a website. Or you might, if you have a website, it, does not tell you much. So we weren't able to corroborate some of that information. But I think we should interpret it, I mean, in two ways. So whether or not tellers were giving wrong answers, it's still the answers that they were giving, right? So if they were accurate, it's bad, and if they're wrong, it's bad. And in both cases, it's the information that you or I might get when we walk in there. So it could be right or it could be bad, and the trends still stand, right? I think that the declining trends still stand.
I was just curious, so from the bank's perspective, I'm curious if they would want to, they would want to actually have their information to tell you if you're correct or not. But let's say the tellers were officially giving this incorrect information, then that could be an opportunity for intervention at the teller level, given that they do have colleagues around them every time they're working in those situations, and then oftentimes they have computers as well to get the right information. Maybe they're just not utilizing those resources.
So, if you have, interest or ideas about what this might look like in the future as a follow-up, I'd be glad to, talk to anybody about that. But one of the things that we are doing this semester is talking with tellers and branch managers to try and understand, what might be happening when they give the responses. So maybe, including these trends here, but also thinking more broadly about where is a point of intervention. These are the moments when, I wish I would have had the 5 years experience kind of working in the bank, that I could understand all of the intricacies and identify specific opportunities for intervention at the employee level. But tellers are also part of a low wage workforce, right? Tellers have a low minimum wage. Sometimes they're put in banks through temp agencies. Their employment in the financial system can be transient. There's not much of a hierarchy for upward mobility. So they are also kind of part of this kind of larger system of finance that also is exploiting them kind of in the process. But talking with them and helping to identify what those points of intervention is a good next step. Yes?
So these are really interesting data. I agree with what I was happening with that. Is there, so you mentioned that the bank, so it's always the main branch, right?
Mm-hmm.
So is there a systematic difference between the types of bank and who responds to the survey? So does asset explain that? Or I mean, it just seems like a larger bank would have a CSR, whereas a small community bank might have teller. Or was that not the case?
Well, so only 5% of our sample are the large mega banks like JP Morgan Chase, right? Those really large banks are, just a small part of our sample. And so mostly these are the small and community banks, the Main Street banks. So I think there's a few parts to your questions, and one I think is, there may be differences, but that's not represented necessarily in our data by sampling some of those larger banks. We don't see differences, or at least any differences that emerge don't explain away findings on race. And I do have, I think here at the end, information on how representative are these main branch neighborhoods of other branch neighborhoods. So if you think that the person who's responding at the main branch might give a different answer than if they were located at another branch within the same bank, but serving different communities with communities that have different racial makeup. So these are our correlations between community demographics for the main branch and banks' other branches, right? So the correlations are all really 0.88 and and 0.90, 0.92. So the correlations between racial makeup of main banks, branches, and other branches are pretty similar. So, you know, we don't see necessarily that we've just sampled the main branch. You know, that we don't see substantial differences, or wouldn't expect substantial differences, given locations in similar communities. Does that kind of address what you were? Okay. Okay. Yes.
In terms of ownership of banks versus the alternative financial services, do we find there any shared ownership anywhere? So there's some sort of like collusion going on in terms of, you know, what's being offered in a particular area? Like, is it the case that some organization owns, you know, can set up either a bank somewhere or an AFS, and they choose to set up an AFS instead of a bank, or are they really just two separate sort of industries, and it's not some sort of matter of choosing, you know, where?
So we do see that the presence of alternative financial services kind of around a bank in our sample relates to higher cost. So, you know, these alternative financial services are present around banks, which could suggest some choice, although choice might be forced, right? Your choice to one or the other, you know, could be forced in a lot of ways, based on how finance is racialized. And we do see, you know, like that significant relationship that we don't see with banks. And so alternative financial services, you know, may be driving up these costs, or banks, you know, banks can also be thinking, because alternative financial services rate are higher, you know, my products and services, you know, I can offer those at a higher rate. Could also be that generally the cost of operating in those communities are, you know, both higher, so banks are charging more. But is that kind of getting at the question that you're asking?
Kind of, I was speaking more about like actual ownership, as in, is there any shared ownership where some organization both owns, say, X bank and also owns X check cashing place, and they're literally deciding, like, are we going to open up a bank here or open up a check cashing place? But your response actually brings something else, because what I'm now thinking actually is there any sort of like time series data that you have that might explain when prices are going up or down, such that, you know, an AFS opening then leads a bank to raise their prices or vice versa, because that also points to something else. I'm thinking of like the CD companies in the 90s when they actually all raised the price of CDs at the same time, which is, I don't think it's like an antitrust thing or whatever, it's not a financial person, but, you know, that they're actually like sort of price fixing together, which is one question. Is there coordination in terms of price fixing? And the other question is about coordination in terms of, I am a financial conglomerate, and I can either open up an AFS or a bank myself, and I'm choosing which one I open up.
So let me address that second part first. So in terms of, you know, banks kind of choosing what they open up, there is some symbiosis there in how they work. And so there's a doctoral scholar, her name's Megan B., she's from Cornell, and she's looking at how banks make these decisions about opening up or financing, right? Another way that they participate in alternative financial services like payday lenders and check cashers as we traditionally think of them. Another way that they participate, maybe they don't open an alternative financial service, but they provide the financial backing, right, for that service to open. So there's kind of emerging evidence on that trend. And your second point was about cost price, the time order of the, and so I don't know of data on that. I don't have that data, and I don't know. If not, you know, it'd be wonderful if they wanted to share some of their costs and pricing, but I don't have time order on, or know of, you know, where there might be time order on that. Yes.
I enjoyed the talk. I am still stuck or potentially confused by one of your findings of that you said that it was on one of the slides that socioeconomic and socio-demographic factors were not as were not predictors. Yes, the last one right there. The socioeconomic work consistent predictors. Do you have any hypotheses as to why they're not predictors? Because in this conversation, it seems like socioeconomic and demographic factors are big contributors to these inequalities. Why do you think there are so many inconsistencies?
Well, that's a good question. So things like education level and poverty rate across, right? We had 5 regression models. I think I showed you 4 outcomes. We had five outcomes that we were looking at, and they weren't consistent. Sometimes, right? Sometimes they were significant, but they didn't. You know, what we were concerned about is concerned with asking is, could they explain away findings on race? So while they may be significant, they might not be significant to the magnitude. You know, matching the magnitude of the relationship between census tract racial makeup and costs and fees. And sometimes they weren't significant. And we do, I mean, control for a wide range of other factors like bank asset class and local market competition that, you know, may have kind of depressed some of what might otherwise have been significant findings. And I think that the fact that, you know, they haven't emerged as consistent predictors suggests that that the racial makeup of communities is driving the costs and fees, and not necessarily, you know, I'm a bank and I locate in a highly educated neighborhood. Maybe I can make more money off of you in, you know, other products and services than in checking accounts. Checking accounts are one of those products that, you know, people with lower incomes subsidize everyone else in the system, right? If you have more money in the system, then your checking account is free. And, you know, based on income and poverty level, that could perhaps help explain some of this, yeah.
As it relates to banks, who has the power to, I guess, weigh or even prevent these, like, overdraft fees? Because I think this might have been discussed before, where some people have or some roles within banking institutions, they have the power where if they see that someone overdrafted because they went to the grocery store, they have the subjectivity to say, you know, let's hold off on that. Whereas opposed, they saw they withdrew money at a casino or whatever, and then they'll probably allow the draft to go through. So, like, who has the power in these banking institutions?
Good question. And I think it is distributed, like, I think power is distributed in different ways that I don't yet fully understand, right, at the branch level. I think the branch manager is a key decision maker here. And so I don't know, so, you know, in some of our kind of qualitative conversations with tellers and customer service representatives, they have said things like this, like, just, you know, we weren't looking for qualitative feedback, and they, you know, willingly gave it to us as we were talking, and said things like, you know, this overdraft fee was triggered at this liquor store, so, you know, we won't waive that. That's, you know, that's how I, you know, that's how I use this policy. That's how I put this policy into practice. Or I know this person from the community. They go to my church, so, you know, of course I'll waive that. And so you know, who ultimately is accountable to that specific decision? I'm not quite sure. In the branch system, you know, where there's a, you know, series of single or series of branch managers, sales associates who kind of deal with a separate line of financial products, more in lending and home mortgages, and tellers. That's more of a decision between the branch manager and the tellers. And you know, the bank president, right, and their board, and at that sort of, you know, higher administrative level, also has the power in their system to decide how these costs and fees will be put into place. one could think of a checking account along a continuum as well. So, you know, if you have $10 in your checking account, but you need to spend $30 at the grocery store, you wouldn't necessarily have to have a difference, you know, a fee charged to you for that. You know, the bank could operate, you know, that line on a loan system and lend you that difference, right, as opposed to charging you an extra fee, which you spent $30 at the grocery store, and I'm going to charge you this $34 fee. You know, you've been doubly penalized there. You know, banks could choose to, you know, operate their accounts more on a continuum, which you know, which would also come at, you know, the bank kind of higher administrative level would have the power to make that decision. But this is a system that works well for banks, right? So they need to have also, you know, as important as like kind of individual interventions and branch level interventions are, they need some external mandates, external requirements, external encouragement to really operate differently this system that works well for them. Any other questions?
Well, okay, we will end it here. Again, I want to thank Dr. Friedline for a great presentation.